As shown in the upper window of the chart, and as anticipated in late July, the S&P 500 broke out above the upper boundary of its ascending triangle. The ascending triangle has always been one of my favorite bullish chart formations, and once again, it performed as expected. We also released a video discussing the strong possibility of this breakout on our TSP Fund Trading Analysis YouTube channel. If you haven't already, please subscribe to the channel and give our videos a like. Your support is greatly appreciated and helps our channel continue to grow. Where are we now? The S&P 500 has reached potential resistance defined by the rising trend line connecting the highs of December 2024, October 2025, and the 2026 highs. This does not necessarily mean the S&P 500 will decline from current levels. Because this resistance line continues to slope upward, the index could still move higher while remaining beneath it. However, the near-term upside potential appears to be becoming increasingly limited. In the lower window, the technical indicators confirmed the breakout, but they are now beginning to suggest caution. The Relative Strength Index, or RSI, broke above the upper boundary of its downtrending channel, confirming the strength of the recent advance, but could soon begin to roll over. At the same time, the stochastics have reached an overbought condition. Together, these indicators suggest that while the broader uptrend remains intact, the market may be becoming increasingly vulnerable to a short-term pullback or consolidation. Accordingly, our current allocation remains unchanged from last week: 30% C Fund, 40% S Fund, and 30% I Fund. However, be on the lookout for a possible IFT change in the days ahead. Another interesting chart worth mentioning is the Market Vane bullish sentiment. As shown in the chart below, the Market Vane bullish consensus, which tracks the sentiment of market professionals and advisors, has surged to nearly 80% bullish. This represents an extreme level of optimism and one of the highest readings in nearly 3 decades. In fact, we have to go back to the summer of 1997 to find a comparable reading. Extremely bullish sentiment does not necessarily signal that a market decline is imminent. However, it can serve as an important contrarian warning. When optimism becomes this widespread, much of the available buying enthusiasm may already be reflected in stock prices, leaving the market more vulnerable if conditions begin to weaken. For now, we view this as a yellow warning flag, rather than a sell signal. Combined with the S&P 500 approaching upper trendline resistance and several technical indicators reaching elevated levels, it provides another reason to closely monitor the market's technical structure for signs of weakening. Another interesting chart is shown below, comparing the historical performance of the S&P 500 during U.S. midterm election years. While no two market cycles are identical, this seasonal pattern suggests that following a generally flat period in early August, the market has often experienced a brief rally into the second half of the month before undergoing a more significant correction during September. However, because many investors are aware of this historical tendency for a late August peak, there is always the possibility that the market could anticipate the pattern and reach its highs somewhat earlier than expected. Accordingly, rather than focusing exclusively on a potential peak near the end of August, we will be watching closely for signs that a market top begins developing during mid-August. The exact timing is impossible to predict, but when this seasonal pattern is considered alongside elevated bullish sentiment, upper trendline resistance, and increasingly overbought technical conditions, there are several reasons to remain cautious as we move through the remainder of August. The CNN Fear and Greed Index is sitting firmly in the greed zone at 61 and has virtually remained unchanged since last week's reading of 60. This placement suggests that investor sentiment has become considerably more optimistic following the recent market recovery. While improving sentiment often accompanies rising prices, a move into the greed zone can also indicate increasing investor confidence and complacency. We will continue to monitor sentiment closely, as periods of excessive optimism have historically coincided with markets becoming more vulnerable to short-term pullbacks. The long-term chart below provides an important perspective on the S&P 500, highlighting several of the major market declines that have occurred over the past 3 decades and the events associated with them. These include the 2000 to 2002 technology and Nasdaq collapse, the 2007 to 2009 global financial crisis, the 2020 COVID-19 pandemic decline, the 2022 inflation and interest rate bear market, and more recent corrections associated with global trade and economic uncertainty. Despite these significant declines, the S&P 500 has repeatedly recovered and eventually advanced to new all-time highs. The index continues to trend higher over the long term and remains within the secular bull market that began following the March 2009 financial crisis low. The S fund continues to trade within a well-defined uptrending channel and remains technically bullish. While the index could certainly move higher from current levels, it would first need to break above its early July highs. This may prove challenging, particularly as the Relative Strength Index, RSI, has reached the upper boundary of its downtrending channel. In addition, the stochastics have moved into overbought territory, suggesting that the S fund may be becoming increasingly vulnerable to a short-term pullback or consolidation. Overall, I continue to believe the S fund remains one of the more attractive opportunities among the stock funds. However, given the increasingly cautious technical picture across the broader market, we may be releasing an IFT in the days ahead. The I fund continues to trade slightly above its well-defined upward sloping channel, as illustrated by the parallel purple trendlines on the chart. The fund also remains above both its rising 50-day and 200-day moving averages, indicating that the intermediate and long-term trends remain firmly positive. However, another set of parallel trendlines suggests that the I fund may now be approaching an important area of resistance. By connecting the November 2025 and March 2026 lows and projecting that rising trendline forward, then drawing a parallel trendline from the February 2026 high, we can identify a potential upper boundary for the current advance. The I fund is now trading very near this projected resistance level, red line, which could limit additional upside in the near term. In the lower window, the technical indicators are also beginning to suggest caution. The Relative Strength Index, RSI, previously broke above the upper boundary of its downtrending channel, confirming the strength of the recent advance, but now appears to be showing signs of rolling over. At the same time, the stochastics have reached an overbought condition, further suggesting that the I fund may be vulnerable to a short-term pullback or consolidation. Accordingly, we remain 30% allocated to the I fund. However, be on the lookout for a possible change in signal status in the days ahead. As discussed in the C fund analysis, we believe the probability of a sizable market pullback is increasing as we move through the second half of August. Therefore, we will be watching the I fund closely for any technical deterioration that could warrant reducing our current exposure. There are two ways to analyze the F fund: using a chart adjusted for dividends and one that is unadjusted for dividends. The first chart shown below is adjusted for dividends. Because dividend payments are incorporated into the historical price series, this chart is generally more appropriate for evaluating the total return of an investment. As shown below, the F fund has continued to trade sideways beneath a well-defined resistance level, reflecting a period of consolidation following its advance earlier this year. Although the fund has been unable to generate a decisive breakout, it has also avoided any meaningful technical deterioration. The second chart shown below is unadjusted for dividends. This chart reflects the actual historical trading prices and is generally more useful for identifying support, resistance, trend lines, and other technical chart patterns. For a detailed explanation of the differences between adjusted and unadjusted charts, please watch our YouTube video, Why AGG Charts Don't Always Match. Dividend Adjustments Explained. If you find the video helpful, please consider subscribing to our TSP Fund Trading Analysis YouTube channel and giving it a like. From the unadjusted chart below, the technical picture becomes much clearer. The F fund remains below a declining trendline and continues to trade within a bearish intermediate term pattern. Until the fund can break above this resistance level and establish a series of higher highs and higher lows, the technical evidence continues to favor additional weakness rather than the beginning of a sustained advance. Accordingly, we continue to maintain a 0% allocation in the F fund. Until the fund provides clearer evidence of renewed technical strength, we believe remaining on the sidelines remains the most prudent course of action.